Good morning, everyone, and thank you for joining us. My name is Antonella Vona. I am the Regional External Communication Manager for Mediterranean and Africa. I'm glad to see many participants today, and as Coface, we are glad to inform you and to support you with the economic outlook. I'm pleased to introduce today's speaker, Marcos Karias, Coface Economist for Eurozone, and Seltem Igun, Coface Economist for Middle East and Turkey. Before I hand the mic to Marcos, I would like to tell you that we will send you back the presentation, and a recorded version of this webinar will be available. We will have at the end a session of Q&A, so you can use the chat to send us the question during the webinar. And without further ado, I let the mic to Marcos. Marcos, is over you. Thank you very much.
Thank you, Antonella. So welcome, everyone. We're pleased to be here to give you our little view on what's been going on in the economy lately. If you've been following the news, I don't know about you, but I get the sensation that what we see is kind of a mixed bag. You know, there's reasons to be optimistic, but there's also some reasons to be pretty cautious about what's going on. On the one hand, I think we can still remain confident that demand on the demand side for the broader economy and for most sectors, you know, things are about as good as they have ever been, or even better than they have ever been. But on the other hand, you know, we have now spent several months, pretty much all of 2021, where many sectors are also struggling on the cost side, on the supply and production side, because of what's been going on with commodities, with certain inputs such as semiconductors, with energy, you know, both the increases in prices and in some cases just the unavailability of certain raw materials and inputs, which are making it so that some companies, they have the demand, but they cannot just supply it. So it's kind of a mixed bag. On top of that, we have certain recent developments in terms of COVID that are not all that encouraging. So let's try to maybe you know, make the balance of all of this. So I will be presenting you a little bit of an outlook for the Eurozone. My colleague Seltem will then be talking about Middle East and Turkey a little bit. So you're going to have this, you know, developed country, emerging market comparison that is very useful, I think. So when it comes to what's going on in the Eurozone, I guess that, you know, we do have to remember that there is one very good news, that at least for what concerns Western Europe, vaccination rates are very high, amongst the highest in the world. Really, during the summer, vaccination campaigns have really, you know, kicked it up a notch and compensated for the slowdown at the beginning of the slow pace of vaccination campaigns at the beginning of the year. We have now among the most vaccinated populations in the world. You will notice that for many emerging markets, including some economies in Eastern Europe that are economically not very far away from us, for instance Poland, vaccination rates are a little bit lower. So of course, this reminds us that there is something that we always have to keep in mind with COVID. Even if we're going out of the pandemic, is never it appears truly dead. So what I really think might be dangerous about this is that, you know, as long as we have emerging markets with low vaccination rates, we're always going to have the risk that what I would call a problematic variant emerges. And by problematic variant, I mean something that would be either extremely contagious or vaccine resistant, and that, you know, can very quickly take us to a more bearish environment. Now, what I do think is a good piece of news is that we have to remember that the pattern that we've been seeing during the later months of the pandemic is that with each new wave of COVID, the economy suffers less and less. You know, you need higher rates of contagion to get a similar negative effect in hospitalizations. So we've been able to manage to get through the recent waves without having that much of strict, let's say, sanitary measures. And even if we do get cases, situations like what we have in Austria, what we have in Germany, where they're really having to make these restrictions a bit more intense, it is likely that they will be shorter than in previous waves, and again that the effects on consumption on demand will not be as strong as they were at the beginning of the pandemic. So with this outlook in mind, here I present to you what are still our current forecasts for the global economy and for certain selected countries. Now, I do have to say that we are in the middle of reviewing our scenario. We're currently in the process where we are reviewing our risk assessments for sectors, for countries, and obviously also our GDP forecast. And given what's been going on in recent weeks, I think it's likely that we will be revising them downwards. There's been a slowdown in China, all this stuff going on with COVID in selected European countries. But I don't think it will be a dramatic downward revision. If we take, for the example, what happened in the United States during the summer, they had some pretty bad contagion of COVID in certain states, in Texas, in Florida. Well, the American economy did slow down a little bit. Certain sectors got it pretty bad, air travel and the classic ones that get it bad during COVID. But the economy slowed down a little bit, but not that much, and then retook their vigorous growth pace in the fourth quarter. So downward revision, yes, bad news, but not that much. And obviously, what might be more of interest to us is what's going on here in Europe. And if we take some European economies, we see that they are rebounding quite strongly, but sometimes with kind of different growth profiles. If we take Italy and Greece, for instance, we know that these are countries that are benefiting a lot from the Next Generation EU fund. We know that out of this 750, out of the 750 billion euros of this fund, 200 of them are being invested in Italy during the next 7 years. If we take it in terms of percentage of GDP, Greece is the country that will receive the largest funds in terms of percentage of GDP, with 18% of GDP during the next 7 years. So obviously, this is being very optimistic for investment in these countries. For the first time in a long time, I think businesses are confident that fiscal policy is being very dynamic, but also on the political side, that's also something that has changed. With the Draghi government in Italy, with the Mitsotakis government in Greece, there is a confidence that these are technocratic governments that are more competent than what we've seen in the last few years. We have populism, the populist forces that are a little bit in retreat. But at least for the case of Italy, I would always caution I would always advise some precaution, because we know that for the intrinsic properties of the Italian parliamentary system, governments, even if on the short term they might seem that they have a lot of support, coalitions can disappear very easily. So I think it's a good thing that there's this confidence that keeps the economy going right now, but always keep an eye. We still think that the Draghi government will be able to finish their term for the moment, but electorally things we know are very volatile and they can change very quickly. The pattern is a little bit different. For economies like France and Germany, where consumption has been a lot more dynamic. The rebound has been a lot more based on consumption, and as we will see later, we might be a little bit uncharacteristically worried about Germany recently, because obviously they are suffering a lot because their economy is very concentrated in manufacturing. They're suffering a lot from supply chain disruptions that we've seen lately. We can only think about the importance of the automotive sector and how much they are suffering because of this. And we are seeing some signs of slowdown in the German economy, not to mention that they are among the ones that are also being affected by COVID right now. So I'm going to be talking about this a bit more later, but we have to watch out for Germany as a bit of a canary in the coal mine for the manufacturing sector. Let's get to inflation, because we know that this is also one of the big topics in macroeconomics right now. We are seeing, as you may see on the graph on the left, for developed countries, rates of inflation that are really given the standards of what we had been used to in the past few years, or what you see here, 2010-2019 average, rates of monthly inflation that are twice or 3 times as strong depending on the country. This is very new. I think that we are not used to this, and this is very shocking. And this is obviously the result of tensions that we're seeing on commodity markets, on transport, on labor markets, on energy. And well, the big question is also always, how long this is going to last. And central banks, as you might know, they are of the position that this inflation will be transitory. We're going to get in the next slide to the meaning of what transitory means. And with every month that goes by, it seems that this transitory discourse is less and less credible. I would caution against that sensation that central banks have it all wrong, because by transitory, they don't mean that inflation is going to disappear from one day to the next. You always have to remember that central banks are reasoning on a different time horizon than us. Why? Because you have to remember that monetary policy takes about 1 year or 1.5 years to take effect on prices. What I mean is that when the central bank makes a decision, that decision of, for instance, increasing interest rates or reducing QE, that decision does not affect the economy from one day to the next. And what they are afraid of here is that if inflation is indeed, as they believe, transitory, that they might raise rates right now, and that will affect the economy 1.5 years from now, where if our growth predictions are true, demand will be a lot more calm. This disconnect between supply and demand that is driving inflation right now will have, corrected a little bit, and they will do something that is recessionary for the economy at a moment where the economy is already slowing down. As you can see on the graph on the right, inflation can be very variable for emerging markets, but I think Sultan will have stuff to say on this, so I will leave it to her. I want to, retake what I said earlier in this slide. Like I said, transitory, to give you like a little bit of more temporal standards. I think that when is the time to worry? The time to worry, I think, is if inflation has not come down by, let's say, the middle of the second quarter of next year. Right now, what we expect is that, especially all these energy market tensions, they might still get a little bit worse. The price of natural gas and everything, they might still get a little bit worse during Q4, the end of 2021, and still the beginning of 2022. But afterwards, this might moderate, and really, energy market is really driving a lot of the inflation right now, and that is, we have every reason to believe that in Q2 that will moderate. With the slowdown of the global economy, and especially the slowdown in China, we should, and we've already started seeing this in certain markets, have things moderate in many commodity markets. There are certain particular cases like copper that is being very demanded for structural reasons. For instance, energy transition, where this might not apply, but in general to most other commodities, this should apply. The real uncertain factor, I think, would be what might happen in the side of wages, and if we might get a wage price spiral. We really don't know if this will necessarily be the case just yet, because, well, on the one hand, we know that wages, I think, will almost certainly grow due to these pressures from the labor market. But the real question is how much, how intense is that growth going to be, knowing that, the bargaining power of workers is not what it used to be, and also it's certainly not what it was in the 1970s, for instance. and also because many sectors have also seen pretty good margins, very good profitability in the last year. And so since they are worried about being competitive and price competitive on their markets, they might, absorb some of this growth in wages, and so their transmission to consumer prices will be lower. Now, this being said, the debate around inflation is very contentious, and I have to, even if I have been broadly sympathetic to the transitory argument, I have to accept that there are good arguments on both sides and good, very smart economists positioning themselves on both sides. So this is really something that we have to monitor. And like I said, we have to monitor duration. Has inflation reached its peak by April, May 2022? If not, that might be cause for worrying. Or if alternatively also the intensity of inflation, if we start seeing monthly year-on-year increases in inflation that become very acute, so this would be like 6-8% for advanced economies, more 12-15% for emerging markets. The American economy is almost here. Let's see if that continues to happen. Europe, I think, is still, under these levels, especially if they are driven by core inflation. And by core inflation, we mean inflation that is not coming from energy prices. Very quickly, I will just say one last word on insolvencies and corporate insolvencies. And, we have to notice that for most European countries, we are still in what I would call insolvency suppression territory, meaning that we have this paradox that we have noticed during all of the pandemic, that even though GDP contracted by a lot last year, insolvencies were as low as they have ever been. This is still the story for most countries in 2021. We have some exceptions like Spain and the UK, where insolvencies in 2021 are above last year's levels and now converging towards levels of insolvencies that are close to what we had in 2019. Or even above in the case of Spain. But still, this is nothing like the wave of insolvencies that many were talking about at the beginning of the pandemic. And so the question obviously is, what will happen in 2022? Well, what are the trends that we are seeing in 2022? We're seeing that it is likely that if it is needed, at least in the first half of the year, states have the permission from the European Commission to continue spending. France has already extended guaranteed loans until the middle of last year, and so I think that things will still stay relatively calm during the first half of the year, even if we start seeing some gradual catch up to the levels of 2019. The real question is what will happen in the second half of the year. Are we going to start seeing insolvencies as soon as the government help disappears? We think it will be a lot more gradual than that insolvencies will start growing, but states will continue to manage a little bit, the flow of insolvencies so that it doesn't look like there's a huge crisis, a huge wave happening right away. With this being said, there's also something that we have to consider is that, not all insolvencies are made equal. And if we think about what we might call the possible hidden insolvencies of the pandemic, these are more concentrated in sectors like hospitality that are not very capital intensive. Businesses are not very large. I would say that now what we have to worry about more, I am more worried about the aftershock and after effects of the supply chain crisis, because this is something that touches firms in the manufacturing sector, especially some suppliers. Let's say if we take, for instance, the automotive sector, suppliers of big auto companies that may not have the bargaining power to transmit what they're seeing on the side of the cost to the selling price. And so I think it's interesting to see what is happening in Germany. Well, what I showed you here before in these slides is just a number of insolvencies, but what we have here is the value of the liabilities that are going into insolvencies. What we see obviously is that insolvencies if there are less insolvencies, but we already have the same value in January, August 2021 of liabilities in insolvency that we had in all of 2020. It means that these insolvencies are being larger, and so I think at least for the manufacturing sector, let's watch out if Germany is not a canary in the coal mine, with less insolvencies but more important in economic terms insolvencies. So this concludes my presentation, and I will give the hand to my colleague Selton for the rest.
Thank you, Marcos. Thank you for this interesting presentation. I give the floor to Feltem. Go on, Feltem.
Thank you, Antonella, and thank you everybody to be here with us today. So I'm going to start my presentation with giving you short wrap up about the GCC growth, then follow up with Israel and Turkey. So we forecast real GDP growth of the GCC region to shift from negative 5.8% in 2020 to 3.2% in 2021 and 3.8% next year, reaching the MENA region growth. The growth story is that so far in 2021, non-oil economy was the real driver of the economic growth, in line with vaccinations and fiscal supports across the region. And most of the GCC economies have the highest vaccination rates globally, such as the UAE, for example, standing at 98% of its total population, and Saudi Arabia and Bahrain at 68%. That allow them to ease COVID-related restrictions earlier than most of the other countries and open up their economies faster. As a result, we see that private consumption and services are strengthening. And on the other hand, rising vaccination rates globally have pushed up energy prices, which resulted in a recovery in the oil sector of those countries and initiation of the infrastructure projects that have been on hold because of the COVID-19. Well, in general, the United Arab Emirates, we can say that it will benefit from the Expo 2020, now which is Expo 2022, which will end in March, while Qatar will benefit from works related to the World Cup, and Saudi Arabia from high level of oil prices globally. And as you can see in the second chart, oil economy in the GCC was negatively affected by the OPEC Plus restrictions. Although production has partly come back to the market, 2021 will be a year when the GCC countries will witness their hydrocarbon output growth to be muted. In 2022, however, GCC is expected to see a strong recovery with mostly above trend growth rates. The recovery that has started in the second half of this year will continue along 2022 and will be supported also by the oil sector. Well, we forecast Saudi Arabia's economy to grow by 3% this year and 3.7% next year, after contracting by 4.1% in 2020, hit by the dual impact of falling oil prices and COVID impacts. Quarterly GDP shifted into positive territory in the second quarter of this year after contracting for almost a year. Yet we saw that the second quarter reading was very low at 1.8% year-on-year, mainly because of the low level of crude oil production. Meanwhile, the strong vaccination has supported non-oil economy, and next year high consumption and investments will probably continue to support GDP growth, and fading impact of the tripling of the VAT implemented in July 2020 will also sustain private consumption. So basically, we expect GDP growth to come from the private consumption and investments, also from the higher output in hydrocarbon sector. Also, net exports will support GDP growth next year. Oil production has already returned to growth, with output standing around 16% higher in October, around 9.7 million barrels per day, compared with the start of 2021. And this trend will continue next year, and 10% expansion in oil production is expected next year, in line with the OPEC Plus decision to reduce supply cuts. Well, the reopening of the economy in Saudi Arabia, recent national investment strategy and the projects implemented in line with the country's Vision 2030 program will sustain fixed investments. Saudi Arabia PMI, as you can see in the first chart, has already reached very high levels, indicating operational conditions in the non-oil sector continue to improve. And this trend will continue despite the government's willingness to continue with the budget consolidation to reduce the budget deficit to around 2% of GDP next year from around 11% in 2020. Capital expenditures cuts appear to shoulder most of the cuts in 2022, as implied in the pre-budget statement for 2022. Well, saying that the investments should be implemented mostly by the sovereign wealth fund of the country and the private sector. Given the government's intention to cut the spending by around 6% next year, we expect wages would be actually unlikely to grow in the coming months. Coming to the UAE outlook, we forecast real GDP to expand by 3.7% this year and 4% next year after a contraction of 6.1% in 2020. Rebounding domestic consumption and exports and also rising oil production are expected to sustain growth next year. And the UAE's key markets will also see rebounds, increasing demand for the UAE exports like hydrocarbons, metals, and chemicals. The key export markets are the MENA region, like Middle East and North Africa, China and India, which will see growth of 3.8%, 6.1% and 8% respectively next year, according to Coface forecasts. Hydrocarbon accounts for around 20% of total good exports revenues over 2021, and the oil production in the UAE will be dictated by the OPEC Plus cut agreement, like in the rest of the oil exporters. Effective in May 2022, well, the country's baseline will rise. As a result, oil production is expected to rise by around 13% next year from a year earlier, while oil exports are expected to rise around 14%. The PMI index in the UAE surged to 55.7 in October from 53.3 in September. That was the fastest rise in activity and new orders since July 2019, backed by the start of Expo 2022. And rapid vaccination also sustains tourism revenues and private consumption. Indeed, most of the Western countries have removed travel restrictions into the UAE, and number of cases are in check, as with the number of new cases dropped below 100 per day in Dubai. And Dubai Expo will also help reviving tourism. Hotel occupancy in Dubai surged to around 81% in October from 67 in September and 85 in August. And revenue per available room was up almost by around 55% month over month in October. So we will continue with the Israeli economy. In 2022, supportive fiscal and monetary policy will allow above-trend growth in Israel, and we expect Israel to grow by 5.5% this year and 5% next year, after contracting by around 2.5% in 2020. And this would be on the back of fast vaccination campaign, which will allow faster normalization of the economy and higher investments, boosted by supportive fiscal and monetary policies, as I said earlier. The government's approval of the first budgets within 3 years will also support growth and investments. In line with the recovery and domestic demand for imported goods will increase, driven by durable good demand. On the other hand, Israeli manufacturers may see their production of high-tech goods curtailed by the global shortages of semiconductors, which will also curb overall growth of good exports. Consequently, we may see the deficit in goods to widen, as you can see in the second chart. Yet, Israel has so far remained quite isolated from global inflationary pressures and rise in commodity prices, as it can produce natural gas. And gas production is expected to rise by 30% year on year next year, while consumption by 13%. However, the rise in global inflation due to the shortage in supply chains and rising transportation costs will start to weigh on the Israeli inflation next year, despite the strength of the shekel. But we still expect the central bank to remain on hold until the labor market starts showing signs of distress. Actually, unemployment in July 2021 in Israel stood at 5.3%, and while this is marked an improvement from 5.4% reading in June, it is still far from the 3.5% rate recorded before the pandemic outbreak in March 2020. That's why actually we expect the central bank to stay on hold, although we may see some increases in inflationary pressures until the fact that until it sees, as I said, preliminary signs of distress on the labor market. Well, coming to Turkey, Turkish economic momentum is gaining pace in line with reopening and quick vaccination, export demand, and slow moderation of the domestic demand. We expect the real growth to stand at 8.5% this year and 3.5% next year, with some upward risks to our forecasts. Turkey's economy had been one of the two economies in the OECD with China that avoided a contraction in 2020. Investments have been rising for 4 consecutive quarters and rose 16% in the first half of this year, mostly on the back of capacity investments. As you can see in the second chart, turnover indices have accelerated in the second half of the year on the back of a favorable base effect, which has been followed by a deceleration in the third quarter. But yet, they are still running above their pre-COVID levels, and we expect this trend to continue until the end of the year. Well, despite the high level of interest rates until September 2021, domestic demand has run stronger than expected, partly due to the high domestic demand pulled forward to skip higher prices in the next months due to high inflation. Despite strong growth of 14% in the first half, strong rise in exports have been able to compensate the rise in imports, and exports reached a record high level of $240 billion on a 12-month consecutive basis. This trend is expected to continue in line with continuous growth in Europe and the intention of Western companies to diversify their supply chain outside of East Asia. Adding to that, rising tourism and transportation revenues, we see the current account deficits would narrow to around between 2 and 2.5% of GDP this year from 5% last year. However, the risks still persist. The uncertainty over the monetary policy weighs heavily on inflationary dynamics of the country. The lira hit its weakest ever level versus foreign currencies due to the front-loaded rate cuts of the central bank in September, October, and November, of a total of 400 basis points to 15%. And the lira's losses around 30% versus the dollar since September and 40% since the start of the year is expected to push up inflation, which stands at already 12%. This is 4 times compared with the central bank medium-term target of 5%. This also increases production costs of companies with producer prices running at 46%, indicating consumer prices will go up further in the coming months. This is not expected to put in peril Turkey's external debt payments in the short run, but it will weigh on households' disposable income and result in a greater inequality. The production, exports, and growth performance have been resilient. We expect this trend to continue and the supply side of the economy to keep its strength, but the sharp depreciation of the lira, coupled with a global rise in commodity prices, may weigh on profit margin of companies, mostly those actually which produce and sell for the domestic market. So that would be the end of my presentation. I can give the floor back to Antonella, and thank you all for your interest.
Thank you, Seltem, and thank you, Marcos, for this interesting presentation. We have some good news for Greece, Italy, and some alert on inflation, and also alert on the sanitary situation. Regarding this, Marcos, despite the success of a vaccine campaign in Europe, there are several countries that are still struggling, as we see, for the pressure on the health system, both in Western Europe and Eastern Europe. Lockdowns are, for everyone, really unpopular. But some governments are applying it, maybe locally, and are considering again as an option. Is there a risk that Europe will miss the train?
Okay. Yeah, I guess it depends a lot on what we mean by missing the train, you know. So by that we would mean a risk that, you know, Europe does not perform as well as other regions. On that front, I would say that, like we covered, you know, like we covered during the presentation, you know, I mean, maybe the vaccination rate in Europe, no, it's not as high as in UAE, you know, it's not 98%, but it's still some of the highest in the world, you know, except for a bit less for Eastern Europe, at least Western Europe. So if Europe is having these problems with the virus, you know, we are not going to be the only ones. It's going to happen again in the US. It's going to happen again in, you know, in Asia. So in that sense, you know, if we miss the train, that train has nobody in it. You know, everybody's exposed to this. If we interpret the question in terms of, well, you know, are we not going to have the growth that we thought that we would be having? You know, to go back to my comments on the slide of the growth forecast that I said. Well, yeah, I do think that all other things equal, these developments that we're seeing with the virus and potential lockdowns should be at least at the beginning negative for demand, and that means that we will grow a little bit slower than we thought we would. But like I said, that doesn't mean I don't think there's reason to think right now that this will be super ultra contractionary shocks like what we had in Q2 2020, or even in the lockdowns that came straight after that. You know, I think that the economy has proven to be a lot more resilient to lockdowns than it was before. And like I said, at least for European governments, they have still the authorization to spend, you know, from the ECB, who is writing the blank checks, from the European Commission to intervene. Now, I do think that a question is, you know, how these interventions to support businesses, households, and everyone else will be now, because like I said, inflation is a worry. inflation is a worry now, and there is a worry that maybe in the last actions from the governments, maybe they were a bit too aggressive and maybe created some inflation. So now they will be, I think, very careful with how those interventions, the form that they take. So, for instance, I think it's always good if, for instance, the interventions are to save certain sectors that continue to be like very affected, like tourism. If the intervention is preventing a ski resort from going into bankruptcy because they are now looking to miss the third season in a row, I think that can only be good. But I think they will also have to be very careful to see how much this fiscal expansion comes to support household incomes, and they want to support household incomes, but they don't want to, at this point, I think, supercharge household income, because what did we see during the lockdowns and during the pandemic is that it's what happened in the United States, and it's why they have so much inflation in the US, is that, well, people have to stay at home, and they can't consume services anymore, and they have to consume manufactured goods. So you have increased demand for manufactured goods. You also have, they tend to spend less on the whole, so they are accumulating savings. And then when the economy reopens, that is more demand for both services and manufactured goods. So there is this risk that if they overcalibrate the fiscal response right now, it will create even more inflationary pressures into last year in an economy that will be a little bit less dynamic. So you get less growth and more inflation, and so that's something that they have to watch out for. But on the average, I would say that there's also a good thing that if growth is slower, then that it gives a justification to the central banks to maybe not tighten monetary policy so fast. And let's remember that, at least for the European Central Bank, one big danger of tightening monetary policy is that it will increase the debt servicing cost of companies and states. And let's remember that if the debt that we have right now is sustainable, is because interest rates are very, very low. And so if central banks have to respond to that, that's also a negative point. So on the overall, to conclude and to summarize, I think that these lockdowns, this potential return of the virus, it's depressing optimism and everything. I'm sure that for all of us, it's bad news that we were just sick of this virus and we're very annoyed with it. But I think that just yet it's time to raise the alarm about the economy and certainly about demand because of this.
Thank you, Marcos. Seltem, the energy prices are rising everywhere and are really an issue for our companies. How higher energy price will impact the economy of performance of the Gulf countries?
Well, as they are the key oil exporters and most generally hydrocarbon exporters of the world, of course, they benefit from this high level of oil prices, but also they also benefit from the increased production levels. So especially for countries that have a higher degree of dependence on hydrocarbon, like Saudi Arabia and Kuwait and Qatar, we expect actually the impact of higher energy prices and also a higher level of production to have a better impact on the GDP growth performance compared with the rest of the region. However, this would be also linked to the growth performance of China and other countries like Europe and India, which remain as key clients of those countries, being their key export markets. So there are actually, because of this outlook, we can say that there are several factors that would affect the level of performance in these countries, but we cannot limit the recovery and rising growth performance of those countries only with the rise in oil prices and the production levels. Of course, this is the first factors that impact positively the growth performance. However, they have also implemented several measures to support the non-oil economy. Especially, I'm talking about Saudi Arabia and the United Arab Emirates and Qatar, because they have huge financial buffers that allow them to support the tourism sector and construction and hospitality sectors that are also expected to sustain their economic growth. Plus, with the easing of the COVID-related measures and high level of vaccination rates, we expect private consumption to come back and continue to support the GDP level next year. But as I said, the growth performance in China will be very important for these countries in terms of export revenues, and also the government's intentions to implement fiscal measures to reduce budget deficits to GDP ratio will also be important in terms of growth performance, as we know that the growth in those countries is very closely correlated to the fiscal spending of the governments. So it helps as much as oil prices and oil revenues, I would say, on the GDP performance. So we will continue to monitor all these factors, but I can say that we consider that the economic outlook remains brighter in those countries compared with last year, and we are mostly positive for now.
Thank you, Seltem. One last question for Marcos, because he has to leave, and we are going to close also our webinar. If you have one advice for business leaders, what would be, Marcos?
Well, I mean, always take me with a grain of salt, because I am not a business leader. I'm an economist, so I'm not qualified in certain things, but I am qualified to talk about the economy and about certain trends that I've seen happening in business and in risk, and I think a lot about trying to predict the future insofar as that is possible. So what I've noticed, I think my takeaway from this pandemic is that we were living in a world where business processes and strategies were before the pandemic optimized for efficiency. The archetypical example is logistics done under a model of just in time. Just in time, minimize stocks, make sure that the supply chain is as efficient as possible, and you're as reactive, and you don't have any redundancies, any excess capacity. And I think that was a model that was adapted to the world in which we were living, let's say, between 1990 and the financial crisis in 2008, or you can even extend that if you want to the pandemic. But it was a relatively stable world. It was, there were certain things happening here and there. But I think that now we are going into a world that is going to be a lot more volatile on many fronts, on climate, on cyber risk, on geopolitical risk, on many factors. And in this situation, I think businesses have to, and I'm not the first one to say this, but I think it's very important to go from an efficiency and ultra efficiency mindset to a resilience mindset, to a mindset in which you have strategies that are that remain true, that remain successful, not only when things are working in business as usual, but when the scenario changes very quickly. And I will not be very objective here, and of course I'm speaking for the house, but I do think that what we do here in Coface, be it through the classic credit insurance or be it through information and strategy, is something that helps businesses build resilient strategies, because we try to help you think about different scenarios of how conditions might evolve, and we try to offer a service that, you know, if the bad scenario materializes, then things are not as bad as they could have been. So, but that, you know, that logic has to apply everywhere. I'm not qualified to tell you how this applies to every single part of your business, but you know, this thinking contingency plans, and you have to recognize that, you know, this sounds very good on paper. On practice, you know, it's always going to be a cost, but it's a cost, I think, that should be seen as an investment that can come really handy when, you know, things become very unpredictable, as I think they will increasingly be.
Thank you, Marcos. One answer, yes or no, because we are really going out of the time. It's a good time and safe for investment in Europe and UK. There is this question that comes twice, so it's important to answer.
Is it time for investment in Europe and UK? I would say it's a better time than it has been in the past. You know, I think honestly, you know, at the start of the pandemic, I was actually surprised. I wasn't very optimistic about Europe. I wasn't very optimistic about Italy. The trends that we were, remember 2019, it was the time of Brexit. It was the time of Salvini and the Fast Start movement in Italy. It was the time of, you know, tensions with Germany, tensions between the Italian government and Brussels. When you saw what was happening in 2019 in Europe, you know, you could only be like pessimistic about, you know, when a crisis comes, you're going to stick together. I didn't think that they were going to, and in the end, you know, they exceeded my expectations and the expectations of many people. Germany has really changed in their attitude, in their discourse towards Europe. So obviously, investing is always a risk, and you have risk everywhere. It's always, you know, a question of making like the comparative analysis of those risks. But I do think that developed markets, developed countries will, you know, they were a little bit disappointing in terms of growth before the pandemic. I think that will be less and less the case. You know, that certainly like this year or next year, growth will be dynamic, and the investments that are being made right now in the energy transition, in infrastructure, and all this, they're not only here to make demand dynamic, but they're also here to, you know, strengthen the productive capacities of the economy, make the economy more efficient. Then again, you know, it depends on what you mean by invest. You know, if we're talking about, you know, opening factories and stuff like that, or we are talking about buying stocks. You know, if we're talking about buying stocks and stuff like that, and we have to always say that nothing that we say here constitutes, you know, investment advice. That's not what we're here for. But stocks might have a lot of stuff priced in. If we're talking about, you know, making commercial prospecting or factories and stuff, you know, yeah, I would say that it's a better time than in the past to invest in Europe, and I think this applies to UK.
And our work is and our mission. We are here for building business together, so we can help also our companies to invest, to check their buyers and their partner. Thank you. Thank you, Marcus. Thank you, Seltem. We are closing now the webinar. I really thank you, everyone, for the participation. You will receive the presentation and the recorded version. I invite also all of you to follow us on our website, on social media. We always have a new publication, and we work to update all of you on this really diverse and changing economy. Thank you very much, and thank you again,
Thank
Marcos.
you, everyone. Have a nice day.
Thank you.
Have a nice day. Bye-bye.
Bye.